The first and foremost thing that I say around everything to do with investing, whether it's properties or other assets, is that we never invest for tax purposes. We invest for asset purposes, which is the capital appreciation that the asset has over the years of ownership and further the revenue that it can generate. So very important. You hear this from many professionals, but negative gearing is not a strategy, it's an outcome. So don't get conned into fancy gimmicks around we can help you pay off your property in 5 years through depreciation. Sometimes it's an elevated or an increased amount of costs that you are paying for a brand new property. But nevertheless, you never invest for tax, you always invest for the capital appreciation of the asset and all the revenue that it can generate for you in the future.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. Today, again, a very special guest. I'll tell you why today's guest is very special. It's Jeremy Iannuzzelli, who has an accounting background as an accountant and is actually, statistically, our most popular guest. And we're doing something very special today. What we're doing is we are answering your accounting questions. We're doing a little bit of a series these days. We've been talking to Callum Rhodes, who is a broker that we have very strong ties with and do a lot of work with Callum. And he's answered a lot of questions that people had for mortgage brokers. Today, we're turning it to accounting. So before we start, Jeremy, how are you today?
Mate, very well. It's an exciting start to the new financial year. I hope everybody's enjoying getting their information to the accountant and hopefully getting some decent tax refunds now, as obviously costs have started to rise with interest rates and council rates. So it's one of those things where there could be a bit of money coming into people's bank accounts. I do recommend always spending it wisely, building those buffers, Emil, especially for the new 12 months ahead, ready for the 25 tax year to start, and it comes around just as quickly as 24 finishes.
Yeah, that's a good point. The difference between getting your tax return in now, getting some refund, getting some cash back, being able to use that to get into a property as quickly as possible is something we've really been stressing recently. Is the gap between rich and poor, or the gap between property owners and non-property owners, is getting wider and wider and wider. And the property market is moving at such pace now. We're seeing it go up by $30,000, $40,000 on some properties over the course of a month. So that's how quickly it can be moving. So yeah, get those tax returns in, get your cash out of the government, so that it's much better for that to be in your bank account rather than government's bank account, and even better than being in your bank account where inflation is basically going to fritter it away, getting it into a hard asset like property. All right, we do have a lot of questions that people have sent in through our social media and emails and responses to podcasts and all that sort of thing. So let's rip into the very first one. We're kind of calling this segment 1. We're going to talk about getting started, because I've got all the questions listed over here. Here's a question. I'm just going to throw it straight at you. I'm new to property investing. What do I need to know to get me started and set me up for tax success?
All right. So I think a couple of things we need to understand is what are the key steps for beginners in property investing, Emil. And number one, the first and foremost thing that I say around everything to do with investing, whether it's properties or other assets, is that we never invest for tax purposes. We invest for asset purposes, which is the capital appreciation that the asset has over the years of ownership and further the revenue that it can generate. So very important. You hear this from many professionals, but negative gearing is not a strategy, it's an outcome. So don't get conned into fancy gimmicks around we can help you pay off your property in 5 years through depreciation. Sometimes it's an elevated or an increased amount of costs that you are paying for a brand new property. But nevertheless, you never invest for tax, you always invest for the capital appreciation of the asset and all the revenue that it can generate for you in the future. So that's first and foremost.
So if I can speak to that, that's a really interesting point, because I haven't heard that articulated before, even though I've been in property for, decade and a half, whatever it is. I think you're dead right. A lot of people do hear like, well, I have this income, I have to pay all of this tax to the government. That kind of sucks because they're not great at using it, right? If you've listened to Kerry Packer, most people in Australia share his view that the government are woefully inept at spending the money that they do have, and we shouldn't really be donating any extra. So as part of a tax minimization strategy, people start looking at assets and thinking, oh, which asset is going to give me the best tax outcome? Whereas what you've just said is don't be looking at the best tax outcome, be looking at the best asset outcome. and that's going to set you up for financial success down the track. Okay.
Absolutely, absolutely. So again, if you're looking after the best tax outcome from your affairs, and that's investing, then you want to be buying the brightest, brand newest, shiniest asset you can purchase, which typically might be in oversupplied areas and under demand areas. But nevertheless, there'll be a substantial amount of depreciation that comes from it, which is good, no doubt about it. Depreciation is a non-cash deduction. It just definitely helps. But in the end, we're after that long-term goal of the capital appreciation and or the revenue that it provides. I think sometimes throwing money away for the sake of it just to get your marginal tax rate back, whether it's 19 or 30 cents or 40 cents or even 47 cents in the dollar, you're still spending that $1 a mil to get it. So I always tell people all the time that your goal around property investing, your goal around investing in general, is how can we make money? And making money will often result in a tax payment that you need to make. And then it's up to you and your accountant and other professionals involved to create a structure for you so that more of the dollar you're earning is staying in your back pocket as opposed to someone else's. So your main goal out there, again, for key steps, for beginners out there, your goal is to find property where ultimately it can generate you in the long term a passive income or capital appreciation, which will see you continue to be able to use equity and grow your property further. So as an accountant, yes, having depreciation is fantastic. It's a great result that comes from the diminishing value of the property itself, but it's not why you should invest in property, which is purely a tax outcome. You're still there for the capital appreciation. Couple things to take and important tax considerations to keep at the forefront of your mind when you are starting is to be diligent. Make sure that you are putting your summaries together on a monthly or weekly or fortnightly basis. I think understanding numbers is important. Like anyone in business, Emil, and I say this to everybody, if someone buys a $100,000 or $200,000 business, they're talking with their accountant weekly, they're getting the books being done by a bookkeeper, they're really looking at their P&L and balance sheet quite closely. But for many people out there that are buying a $300,000, $400,000, $500,000 or $600,000 property, it kind of becomes an afterthought, and they don't generally look at how their property is performing on a monthly basis. They're just gauging it by the cash at bank, and that's not a really good way to understand how your assets are performing, because the more knowledge you have as a beginner, the more knowledge you have about the numbers around your investment, it's going to give you that success and confidence to understand, well, what's the next type of asset I need to buy to help maybe pigeon pair or offset some of the potential losses or potential income that I'm generating from my asset base or asset or property portfolio. So I think one of the big things I see a lot of beginning investors fail at is wait until the end of the year to understand the performance of the property. There's some really great tools out there, whether it's Excels or applications that you can use, where you can really start to understand how your portfolio is moving and tracking on a monthly basis. Maybe not weekly, but definitely fortnightly or monthly is important, because you need to know where your falls, where your gaps are, so you can plug them quite quickly. And that's going to help you produce better results for future assets that you purchase in the future.
I think what you're saying is incredibly important. So you'd recommend weekly, fortnightly, monthly, making sure that you understand exactly where the numbers are pertaining to your portfolio.
Absolutely, absolutely. Because then you can start to forecast a mill, especially if rates are coming up or down, or you want to be more aggressive with the type of properties you're purchasing. You want to really speed up that process. More information, more knowledge you've got that you can share with your professionals, the better outcome and the better advice you're going to receive to be able to move forward in the right way. And that's where I feel a lot of people fail. They're not great with the admin side of things. And believe it or not, to be a successful property investor or just successful in business in general, is you need to make sure you know exactly where you are at any point in time. And that's going to give you an informed not what's going to give you an informed decision or informed mind frame that you can start to make the right decisions, especially moving forward with new asset purchases. And that's where I see really successful people do well. They're really in tune with their financial circumstances. They know exactly their outgoings and incomings, and they really then can make key decisions in consideration with their situation to make sure that they're progressing moving forward. So yeah, admin unfortunately there's a lot of admin in property investing. It's not one of those things that you just, go to sleep at night, it's all done for you. I strongly suggest getting really in tune with your financial circumstances and your situation to make the right decisions moving forward.
This feels like it's a reasonably new phenomenon. I imagine 10, 15 years ago, as people were investing in property, you could invest in the property, interest rates were what they were, you work out what the deficit is, and you're just sort of paying things as they go along. One thing that's really changed the environment these days is the record growth that we're seeing across the property market at the moment. And I mentioned at the top of the program, we do see properties that go up by 30, 40, 50 grand in the course of 30 days. And some people can purchase a property and then by the time they've settled, get it revalued. And sometimes it's up by 100 grand kind of thing. Right now, you could say that sometimes you get a lucky valuation, but overall, the market seems to be moving at breakneck speed at the moment. What that means is now more than ever, making sure you're checking in on what the actual numbers are every week to see how much has it grown, how quickly can I recycle and get into another property, because that can make a massive difference, right? If you're on top of your numbers, you're speaking to your accountant, you're talking to your broker, you have a really good understanding of your property portfolio, and you can pull out equity 2 months earlier, 3 months earlier, that could be 30 grand, 40, 50 grand cheaper that you're able to buy your next property at. So that is really, really important. And I know a lot of people listening to this who might be a little bit more like I am, which is a bit more sort of casual when it comes to this sort of thing. Oh yeah, I'll get round to that. I'll take a look at it. The difference between like getting off your bum and doing it right now can be hundreds of thousands of dollars cheaper that you're getting into the property market. And that means hundreds of thousands of dollars less borrowing capacity gets used in that. It can just exponentially improve things for you across the board.
Absolutely, absolutely, and I think the last thing, Emil, is just really some common pitfalls to avoid. Now, this is very basic stuff, and many people go, "Oh, I've heard that before." But for some people, this might be the first time that you're understanding what are some common pitfalls, especially around tax considerations. One of the big things that I see is just the default, especially when you've got maybe two people purchasing a property. It's the default of just buying a property 50-50. It's understanding and maybe chatting with your solicitors about what tenants in common and joint tenants actually mean, because they are very two different ways of owning a property when two people are coming together. But as an accountant, Emil, I generally advise clients to really understand, well, whose name should the property go in? For many people out there, especially through spousal benefits, they're able to borrow together with one person owning the property, such as maybe a husband or a wife or a partner. And that gives you an opportunity of really matching the business plan of the property, the type of property you're purchasing, the yield of the property, the outcome of the property, and then really putting that in the best person's name to really absorb the best level of benefit or the best structure, where it could be a trust or a super fund for argument's sake. So getting those things aligned, understanding the property's numbers, what's the business plan for the property, what do you want as an outcome, and then making sure the right person goes on the contract, because it could be the difference of getting an extra 7, maybe an extra 10, maybe even an extra 20% in tax benefit, depending on the outcome of the property, whether it's positive or negative. So a really good example of this, Emil, is potentially husband and wife, where the wife might be at home looking after the children, maybe going back to work 1 or 2 days a week. Her income's relatively low. Well, if you put in the property 50-50 and it's quite negatively geared, and you've got a husband maybe earning 150 grand a year, again, using this as an example, then ultimately what's happening is the wife's getting very little tax benefit, if anything at all, in her couple of days of work a week. And that means the family's missing out on potentially 20 or 27% tax benefit on 50% of the outcome. So while it's not going to be extremely detrimental to the overall outcome of the property or the overall balance sheet potentially of the family, those 2 or 3 or 4 or 5 grand worth of tax benefit you might be missing in those earlier years makes a huge difference to your back pocket at the end of the year. So it's understanding the business plan of the property, the situation, the income of the respective person and what your outcome is, and then making the right decision of who owns the property. And it goes vice versa. If you're looking at a property where there's a great opportunity for it to become positively geared, so it's got a very clear path to positiveness, well, then it might be worthwhile to forego 1 or 2 years worth of negative gearing, for instance, for the long-term benefit of putting it in the lower income earner's name. And that's where there could be a substantial amount of tax that you save for the duration of ownership. And that goes for things like structure around trusts, and especially around super funds as well, because each structure carries very different tax variables, very different opportunities depending on the family, the property that they're buying, and the outcome that you're after. So that's one big thing, getting the structure right, whether it's a person's name or trust or super fund. The other one is lending structure. Emil, I see that happen all the time.
Just before you jump into that, I want to speak to what you've just talked about the purchasing structure, the structure that you're purchasing under. And you talked about how if you do it in the right way and you're not necessarily 50-50 or tenants come, whatever it is, If you do that in the right way or an optimal way, cash flow wise, that can be an extra $3, $4, $5,000 in your back pocket at the end of the year. Now, at the moment, we've got a living affordability crisis, a cost of living crisis, right? And so that extra 3, 4, 5 grand, that can be great, right? That can really make things a little bit easier for you. But even what I would consider potentially more important than that is how much it can increase your borrowing capacity. An extra 3, 4, 5 grand in your back pocket, that could be an extra 50 grand that you could end up being able to borrow. Now, obviously, it's not financial advice. Talk to Callum, talk to our broker, Callum. But that extra 50 grand, that can be the difference between going, oh, I can only borrow 400K. There aren't a lot of good properties around at 400K. Oh, I can get up to 450. Okay, that changes things suddenly, right? Or if you can get up to 500, that changes things massively. Like being able to get up to that, suddenly the number of properties that are available, the number of good properties in good locations that are available at 500 is like 10, 20 times the number of good properties that are available at 400 or 450, something like that. And it really opens up options to be more selective and get higher performing properties. And it all comes down to buying a property in the right structure at the get-go. So I think that's really, really important. And I think it's an overlooked benefit of that, because right now it really does feel like we've got to be optimizing. 20, 30, 40 years ago, you buy the property, you wait 3 or 4 years while you fight the interest rates to bring the mortgage down and that sort of thing before you're ready to go again, right? Which might take 5 years in order for you to get borrowing capacity. The market wasn't moving as much, but it was harder to borrow because of lending criteria and interest rates, right? If you look in the 80s when the interest rates were much higher. And so waiting a year or 2 or 3 before you get into your next property, like a lot of people I know would have waited 5 to 10 years to get into their second property. Now, if you can get into one and then you can really optimize and squeeze out every little dollar, how it's going to look in terms of cash flow and equity by being very nimble, getting really, really good advice, that can make a massive difference.
Absolutely. And there's so many people I see that just unfortunately default into, ownership category where it might be 50-50 for argument's sake, or they might put it in the wrong person's name, just not really understanding what the business plan of the property is. So like anything, when you're spending 3, 4, 500 grand on something, you want to make sure you've got a very good plan for what this property may look like in the years to come and what you might want to do with this property, whether it's a buy, build and sell, or it could be a buy, renovate and hold. It could be a granny flat property, subdivision property. There's many different reasons as to why you might need to put the property in a various or very different structure. And it could be, again, based upon the outcome you're willing to achieve. One of the last things that I do see, Emil, especially around, is the lending structure. Now, it comes back down to the time that you spend with, obviously, the mortgage broker and the effort that they and you put in to do this. But as an accountant, I really try to encourage my clients to tell a bit of a story around their lending. And it becomes important, especially when you're trying to determine what level of equity or interest that you may be paying and equity you've drawn out, where we can claim it, what we can claim it against. So I do see that happen quite a bit, where they might extract equity out of property A to purchase property B, but they're claiming that equity interest on property A. And that's really because maybe they don't really understand the lending structure, or a loan split hasn't been done properly. So it's been one of those things that I really try to educate clients on. Hey, if you're extracting equity, I should say, my apologies, out of property A, create a split. You can actually, with the broker, create a very special split loan where it segregates that portion of equity you've extracted out of property A. You can now very clearly show that that amount of money has gone for deposits and costs of property B, and therefore there'll be no issues with identifying to the tax office or the accountant that this portion of the split money was used to purchase property B, and therefore I'm claiming the interest in property B. So lending structure and a story around your lending becomes very important. I see so many, especially new beginning investors, they don't understand the importance of this, and again, being able to track the right amount of interest to claim in the return. And I generally see this against their owner-occupied properties. They may have extracted 100 grand out of it, haven't split it off, and then it becomes really tough to determine from the original loan what is deductible and what's not deductible. And therefore they're losing maybe 4 or 5 or 6 grand worth of deduction, Emil, which can come back to maybe 2 or 3 grand in tax refunds. So that lending structure, the lending strategy is so important. The story behind it becomes equally as important, because you need to be able to share this with your professionals so they can get the outcome that you want or deserve based upon what you've done throughout the years. So that is a big thing that I see a lot of people miss, especially for new investors. And it just is around the education around your lending and your lending structure.
Right. So if we are to take the ownership structure, and if we're to optimize for that, that could be another 3, 4, 5 grand that goes into the back pocket. If we optimize the lending structure when we're taking equity out of one property and putting it into another, then that could be another 3, 4, 5 grand. That could be 8 to 10 grand now in positive cash flow that you can say to the bank, look, we've got this extra 10 grand a year, borrowing capacity shoots up by 50, 60, 70, or whatever it is, talk to the broker. But then you don't have to, you that cash flow, that 8 to 10 grand, whatever the number is, you don't have to put that into the property. That's just to tell the bank, look, we've got it there if we need it. You can go on a holiday. You can upgrade the car. You can pay for more education for the kids, whatever it is that you want to do, right? So you do have all of these options. And I think that's, I've said it already in this podcast, and we keep on talking about it in our podcast. It really feels like we are in an age of needing to optimize this stuff. The number of people I know who would have a property, a personal place of residence, split just 50-50 with their marriage partner, and then they go and they buy another, and they think they're smart because they have the mortgage offset set up with a variable loan. And so the savings goes in here, and then they pull that out and they put it in, and maybe they pull some equity out from the property as well. And it just goes over here without any of the forethought, without any of these little strategic optimizations that you've been talking about. And they're losing 3, 4, 5 grand a year, which means they're potentially losing 50 grand of borrowing capacity. And the difference that can make right now, like that 3, 4, 5 grand worth of cash flow, positive cash flow that you can tell a bank, that is a highly leveraged characteristic of your economic situation, right? If you can say to the bank that you're getting that much, you can leverage that into a property months earlier than you might otherwise be able to, or get a much better property. It makes a massive difference.
Yeah, and I think that's one of the main things. It's just people really knowing what they're doing, having a bit of a story documented, getting in tune with their financial situation and circumstances. And then that means you're better prepared. You're really better prepared to share with your professionals. And like anything in life, Emil, the more you can talk about it, the more you can actually start to own what you're doing. You're learning so much along the way as well. It just confirms all your thinking and your strategies. And they're probably a couple of the major things that I see from a beginning perspective. There's a lot of other things that we could talk about, and we can dig down deeper into lenders' mortgage insurance and potential strategies from a debt recycling point of view to aid in better tax results and structure around trusts and super funds. But I think for key steps, important tax considerations and some common pitfalls to avoid them, I think if people really look at those and educate themselves on it and speak to the right professional to ensure they know the ins and outs, then you're going to have a better platform to springboard off, especially when you start to build your portfolio to be much larger in the future, because you've really got that solid foundation, those piers sunk really deep into bedrock, where you can start to build a substantial portfolio from.
Awesome. All right. Well, let's move into, we're still in segment 1, and this is a question that I imagine you get asked every week, maybe every day. And it's a question about being a sole trader, right? So you've got someone who runs their own business as a sole trader. Now, is it sensible to convert to a company structure for tax purposes when you're taking on an investment property? Or is the additional tax flow not large enough to make a noticeable impact?
Yeah, well, it's that's it's a question I get asked all the time, and there's so much intricacies around it and ambiguities that I suppose need to be explained and identified. But a couple of things is to note is there's a concept called personal services income, or otherwise known as PSI, and potentially PSB, and these are just accounting frameworks and legislation that stops people hiding behind the corporate veil, essentially stopping people from acting as a company when really they should be an employee. So anyone who's out there wanting to move from a sole trader to a company, it's really best to speak to your accountant or advisor about PSB and PSI. Those 3 little letters mean a huge amount in terms of the tax that you can save if you're looking to utilize corporate entities as a tax structure. But more commonly, Emil, how I really explain to people around sole traders and companies is sole traders is really a beginner, hobby level style of entity. tax office brought it in to stop all the complexities and the red tape that you have to unfortunately partake in when you go down a corporate level, such as a company where you trade and conduct your activities. So for many of my clients, I'll say to them, hey, if you've got a business you want to look at doing, or you might be a hobby market, Sunday market person, a sole trader is really fine. It's just a really great way to dip your toes into the industry. But it's not really good from a asset protection point of view because you are trading in your own name. And from a tax consideration point of view, it's probably not the best either, because any profit that you generate in that financial year, you will pay tax on at your marginal rate. So if you have that really cracking year and you made 200,000-300,000 profit, while it sounds fantastic to do it, you could be losing a huge portion of it to tax, even if you need to retain some of these profits for argument to invest in your business a bit later on down the track. So companies do carry a much lesser tax rate, a fixed tax rate of 25% if you're deemed as a small to medium enterprise, and a 30% if you're a much larger billion-dollar business, of course. But for argument's sake, and for many of my clients, a company structure would be the best way to conduct their business moving forward, as long as they pass a number of different rules. But essentially what it does give them is the opportunity to minimize their tax, because they can pay themselves a wage up to a certain threshold if their budget allows them to obtain that level of income moving forward, which is great. So that's a great way to streamline your tax. And then at the same time, any profit that the company generates, it's taxed at 25% for most small to medium enterprises here in this country, being Australia. So there are some substantial tax benefits involved when in a company compared to a sole trader, but there are cost benefits being a sole trader compared to a company because of the less red tape. Some people choose to stay as a sole trader because this is a big one, and I don't know why they do this, but they argue with me about it. It's not mandatory to pay superannuation as a sole trader. So some people say, well, I'd rather have all the money coming to me, and yes, I'll pay tax on it, but it's not mandatory to make contributions if you're a sole trader to your superannuation fund. I argue them quite a bit because of the concessions and the tax concessions involved with contributing to super, and obviously the ability that if you do have enough in super and you're happy enough and ready enough to control it yourself, you do have the opportunity to invest your super in your self-managed super fund and therefore conduct your level of investment the way you wish to. So anyone out there that says sole trader is better because of the voluntary status of making concessional contributions into super, I challenge you on it, because the tax benefit alone in doing that could sometimes mean the difference of tens of thousands of dollars as tax savings. So there's some of the advantages and disadvantages: asset protection, tax minimization and tax planning, and the ability to retain profits. So if you structure your company the right way, you can have trusts involved as being shareholders of a corporate entity, which gives you a further layer of tax minimization, Emil. So definitely significantly more advantages being on a company side, with the main disadvantage going to a company would be the level of cost. Big ones are the tax implications. I think this is a big one: tax implications and financial impact of each structure. You do need to understand that they will carry very different tax implications, especially around superannuation now being mandatory based on wages. Workers' compensation for most states needs to be paid inside companies as well. One of the big ones is lending. So how you own the shares of your company, how many shareholders are in your company, how many directors are in your company. I do see a lot of family members come together in a company. It might make $100,000 profit. There might be 5 shareholders and 5 directors. Even though your company is making $100,000 worth of profit, when you go to the bank from a borrowing capacity point of view, they will look at the profit that the company's making, but then they'll break it down to what your share is. So you do need to make sure you understand how the structure is, what a director is. A director is not necessarily an owner of a company, it's more of a manager. There's a risk attached to it. What a shareholder is and what that means from your borrowing capacity point of view. How you structure the company also can increase your borrowing capacity too, Emil. There's this misconception out there saying that you just need to pay yourself a lot of wages and you'll get a lot of borrowing. For my circumstances and for many of my clients, the profit within inside the company, when they 100% own it, for argument's sake, through their structure or in their own names, the profit can actually be used on the individual's name from a borrowing capacity point of view. So you don't necessarily have to pay yourself a stupid amount of wage and pay a stupid amount of tax. The banks will actually start to look at the profit your company is making to assist your borrowing capacity. So that's something that not a lot of people knew.
There does seem to be a huge amount to it. And I guess it's one of those cases where I've heard this expression before. When you go and speak to an actual professional, right, be that an accountant or or a mortgage broker, right? Those are the two people where in property investment you can there it's like there are doors that you don't even know exist that are suddenly open, and behind those doors are bags of money. If you can, but you need to talk to the accountant, you need to talk to the broker to work out how to do it. And to me, and I've said this before, it feels absurd, right? Like, it's me buying a property. That's it, right? It's me, it's the property. I'm paying that person the money for it. I have a business that earns this or a salary that earns this, and now I'm buying that. And yet, if you fill out this form, you pay this much tax and you get this much back from it. If you fill out a different form, then it happens differently. If you fill out this form, well, they might say no, but it's worth trying. All of these, I mean, to me, it seems absurd. It seems like completely unnecessary, bureaucratic bullshit. And yet, that is the system that we live in. And so, if that's the game, we can't change it. We didn't create it. We're just trying to optimize within that, right? If you don't like the system, complain to your politicians, right? Um, but if this is the system, then why not win? And if winning means, you got to talk to your accountant, you got to talk to your broker, work out how to squeeze out that extra two, three, four, $5,000 here. Work out the real. I mean, these optimizations that we're talking about, I would wager that they were much less necessary 20, 30, 40 years ago, right? Things were a lot slower. The differences weren't as big. But now it feels like they're just getting bigger and bigger and bigger. And there's this little, the tactics are getting more and the strategies are getting more and more sophisticated as well. Would that be accurate, or is this always sort of bigger?
Absolutely, absolutely. The red tape, as we all know, is only becoming much larger and much more complicated. And navigating that red tape and the bureaucracy of it all becomes very important. So, planning with your professionals is probably more important than reacting in many cases. So, if you've got a good opportunity to be able to plan accordingly, and that comes with having the right structure at the right time, that's where, again, it leads us into probably our third one, which is scenarios where changing structure might be beneficial. And this is all around the planning side of things. If your business is growing, or you know that you've got a great opportunity to get into business and grow quite rapidly, how you lay the foundations of your structure from your business and trading perspective will be the difference of tens of thousands of dollars in the long term, especially around people looking to really invest in their business quite heavily. Having the ability to invest after tax dollars where the tax rate's only 25% in a company, as opposed to potentially as high as 47 cents in your own name. That difference of 22 cents in the dollar becomes a difference of you being able to grow something quite strong or something that's quite mediocre. So tax, I use this terminology all the time. A dollar saved is a dollar earned. Use that as part of your tax strategy. If you can save tax, that is effectively you earning extra money because you're not handing it away to other people to utilize and spend on your behalf. So dollar saved is a dollar earned. And yeah, structure is key for that.
It's much easier to earn that money by talking to your broker, talking to your accountant, rather than talking to your boss and saying, hey, I know times are tough. I know it's a difficult economy, but could I have a bit more? It's much easier just to talk to your accountant and say, how can I change things around a little bit and just get that cash flow up?
That's it. So again, in summary, Emil, when you're changing between, say, a sole trader or a company, really have that business plan in place. Where do I want to take this particular entity? How long will it take me to get there? And that's where you will set your pillars quite deep down into the earth and be able to really build off a solid platform, especially with a significant level of tax saving in the back of your mind as well. There's no right or wrong answer. It's just making sure that the planning's done all up front. Again, for many people out there, when you do start your own business, especially coming off of full-time employment, there may be a period of time that you need to wait for lending. So I always encourage people to try to get as many, assets as you can under mortgage based upon what your goals and objectives are. Once you've done that, once you've hit that goal and going into business is your next stage or your next hurdle in life, you do that knowing that you may not be able to purchase properties for a period of 1 or 2 years, depending on banking policies. So there's a lot of other things that you need to really think about, or other concepts that you need to come to grasp with outside of just saving tax or protecting your assets. It's what are all the indirect impacts? And again, that's through working with your broker and maybe your property professional knows a bit of your accountant, getting them all on board and sharing with them what your next 1, 2, or 3 years looks like, especially around the business side of things. they'll hopefully give you that advice to say, hey, get everything that you need to done now, get everything you need to do now while you're lending strong, maybe through your PYG income earning position. Because when you go into your role as a sole trader or a company, you may be out of the market from a lending perspective for 1 or 2 years as the banks start to look at you from a lesser risk profile, knowing that, hey, you've gone through a couple of years of business now, and we trust that you're going to continue to move forward in this direction.
Awesome. All right. Well, that feels like a very, very good note on which to conclude this part 1 episode of Your Questions Answered with Jeremy Iannuzzelli. Thank you so much, Jeremy. I think the biggest takeaway that I hope everyone listening to this is getting from this episode is, if you think you should be a sole trader instead of a company, talk to your accountant. If you understand all of the different structures in which you could be purchasing a property, talk to your accountant. If you understand all of the different lending setups and the way to establish your loans and things like that, talk to your accountant, because like I said, doors that you don't even know exist right now might suddenly be open, and behind them there are bags of money that you can get just by having an intelligent conversation with Jeremy. And if you don't do that, you're giving cash usually off to somebody else who's going to be investing in the property that you might want to get into, or even worse, the government, and we know how incompetent they are. So thank you very much, Jeremy, and we'll see you in part 2 next week. And if you're listening to this, make sure you tune in a week's time, and we'll be listening to more of Your Questions Answered, where we're going to delve into trusts, which are very, very important. I know that those are super popular at the moment. We're going to talk about tax variations and lending as well. Alrighty, from myself and Jeremy, thank you so much. We'll see you next time.